All right, we're on the reading credit analysis models. And our first learning objective, we have to explain expected exposure, the loss given default, the probability of default, and the credit valuation adjustment. And we're really just explaining this stuff because we're not really going to use it for another couple learning objectives here. But there's a few things we really need to understand if we're going to understand what happens later. So I'm going to spend a little bit more time on A. And if you get A, or at least what's going on in A, when I say what's going on, why are we doing certain things, you can sail through the rest of this reading. It is easy to get through. It's not difficult at all. Contrast that to the previous reading for credit analysis models that this one did replace. That one was brutal. That one's gone now. So this reading here, this is a cakewalk. All right, let's begin with the idea of the credit spread because we have to point out two important things. Let's say that we have a corporate bond and we observe its yield to maturity, and we have a government bond and we observe its yield to maturity. The difference between these two yield to maturities, and we should expect to see a difference, is called the credit spread. And if it's over the government bond yield to maturity, it's called a G spread. A more appropriate way of describing the credit spread, as opposed to saying it's the extra yield to maturity over the government bond yield to maturity, we would say the benchmark bond. That's a better way to describe it because it does not have to be a government bond. When it is a government bond, we describe it as a G spread, but it does not have to be a government bond. So typically we would just use the generic word, the benchmark bond. Also, the entire difference between those two yields is attributed to the credit spread. Even though within that difference there might be some liquidity difference and some taxation differences between the two bonds that are reflected in the yield. For this reading, we're simply going to say, look, let's just not worry about that. Let's just assume it's all credit spread to make our point. All right. So let's look at some definitions here. I got a list of words here we have to go through and understand what they are. Default risk, likelihood of an event of default. And POD is the probability of default. Default risk premium. This reflects the uncertainty in the timing of default. And let's see if I can distinguish between those two for you so that you understand the difference between them clearly. Let us say that we have a 5-year bond. There's 0, there's 5, and let's say it's a AA bond. And we want to know, well, what's the probability of default of a AA bond? Well, we go back in history and we look at a whole bunch of AA bonds, and let's say we find 100 of them, and we say, 2 have defaulted over the past year. So we would naturally conclude, well, there's a 2% probability of default in this class of bonds. So this bond probably has a 2% probability of default. The credit spread will reflect a higher probability of default. Now, why is that? Well, you have 5 years here. 2 have defaulted. Sure, 2 of the 100 have defaulted. Maybe 1 here and 1 here. So if we expect a 2% probability of default, when will it occur? That doesn't change the historical record. We see that 2 have defaulted, but we pay no attention to when they've defaulted. So the default risk premium reflects the uncertainty in the timing of default. So if there's a 2% probability of default, we might have 2.4% as the probability of default in the credit spread to represent the extra uncertainty of when that would happen. Credit risk, given default, how much is likely to be lost? That is the loss given default. We can have a bond with almost absolute 100% default risk or probability of default. It's going to default, we know it is, but we could have 0 credit risk. The bond could have collateral that is worth far more than the bond itself, that even if the bondholder stepped in, grabbed the collateral, liquidated it, they would be more than paid back. 100 cents on the dollar. So there's no credit risk there. So you can have default risk and credit risk, which is unrelated to the default risk. Credit risk is its own thing. Expected exposure. This is the amount of money that could be lost in default without considering any recovery. All right, so I want to explain this because there is typically a question that arises with expected exposure. First thing, let's recognize that it is expected exposure and not exposure. So let's say that we buy a discount bond for 80 and 2 years later it defaults. As far as Revenue Canada is concerned, or I say Revenue Canada because I'm here, or any taxation authority is concerned, you've lost 80 bucks. You spent 80, you've lost 80 bucks. That's it. They're going to hear no other argument. How much did you spend and how much did you get back? That's it. If you get nothing back, you lost 80. But that's our expected exposure is not just what we paid. It's what we've earned and what the bond would be worth if it didn't default. So let me give you an example down here. Let's say we have a 1-year 4% bond at par. In 1 year, the minute before we get paid, if we get paid, our expected exposure will be 104. 100 because we bought the bond at par, plus the $4 coupon. And this is where some confusion steps in, and students say, well, we didn't pay that $4. I mean, if we don't get it, okay, we don't get it, but we really didn't pay it. How can we lose something we didn't pay for? You earned it. In a year, your money has been working for a year. Your money has earned that $4. You've earned it. So think about it this way. You're going to start to work for me on Monday, and I'm going to pay you on Friday. On Friday, I don't pay you. I default. How much have you lost? Well, one argument, if you're going to use the argument that why are we counting the coupon, your argument is I haven't lost anything. I mean, I didn't put anything up. I haven't lost anything. I don't think that's going to work very well. You're going to say I lost a week's wages. You said you'd pay me, let's say, $1,000. You didn't pay me I'm out $1,000. Even though you didn't lose $1,000, you've earned $1,000. Well, here your money has earned that $4. We're going to see a little later on that if this were a 2-year bond, our expected exposure after 1 year is 4 plus the 4 we would get at the end of the 2nd year plus the 100. Discounted back to this point in time, to 1 year in time for where we stand. And the question there is, hang on a second. Now, I get that we've earned this $4. I get that. Okay, fine. But we haven't earned that other 4. How come that is our expected exposure? And it's true. No matter where you stand, your expected exposure will be what's owed to you that day, plus what's everything that's owed to you into the future. Well, how can that be? Let's say we go back to this example here. Monday to Friday, I'm supposed to pay you Friday. I don't pay you Friday, and you say, well, hang on a second now. You owe me for next week and the week after and the week after that and the week after that. How can that be? How can that be? Well, all of this over here represents what, if you take the present value of this, it represents what you could have sold the bond for today. Well, you're out that. You're out the opportunity of what you could have sold it for. So that is your exposure. And what could you have sold it for? You could have sold it for the present value of all future cash flows. So that's part of your expected exposure. I'll say more about this a little later on, and I'll say more about why we're discounting it at a risk-free rate as opposed to the bond's yield to maturity. I just want to get the definition of expected exposure out there and explain just a few little hiccups with it. The recovery rate, this is the percentage recovered in default. It varies by industry, seniority, the company's total leverage, the type of collateral that was put up. Loss severity is 1 minus the recovery rate. So let's have a look at an example here. Let's say we have a 40% recovery rate on a particular bond. Let's take this 1-year bond. And our expected exposure in 1 year will be 104. So when we say we have a 40% recovery rate, we don't just mean 40% of par. We mean 40% of our expected exposure. So our loss given default is our full exposure. And if this is our recovery rate, 0.4, our loss given default is 1 minus that. Our loss given default will be 62.40 per 100 of par value. So it's not just that we take the 100 and we say, well, if we have a 40% recovery rate, that means we'll get 40 cents back on the dollar, or $40 per 100 of par. We get 40%, or sorry, we'll recover 40% of our expected exposure. That's why it's important to know what the expected exposure is, how to calculate the expected exposure. Once we have that, we can apply the loss severity to it, 1 minus the recovery rate, to figure out what our loss given default would be. All right, on this screen, I want to sort of solve two little puzzles. The first one is, why are we using risk-neutral probabilities of default as opposed to the actual probability of default for a particular class of bonds or for a particular bond itself? And the second one is, when we're calculating our expected exposure, why are we discounting any future cash flows at a risk-free rate? Is this still not a risky bond? Are these cash flows still not risky cash flows? Should we not use, at the very least, the bond's own yield to maturity to calculate what the present value of those cash flows are? If the argument is that we could sell the bond, well, we certainly wouldn't discount it at a risk-free rate, would we? So, two puzzles, and if we can understand these two puzzles, then we can motor ahead just fine. All right, top corner up here. Let's say that we can buy a bond for 100 today. We're buying it at par. If the bond does not default, we will get 104 in one period. Let's say that's a year. If it defaults, we'll collect 40 cents on the dollar and we will get 41.6. Let's calculate a risk-neutral probability of default on this one. Well, what we need to do is figure out what the we know what our payoffs here is. We need a probability here and a probability here of these payoffs discounted back to today at the risk-free rate to equal 100. And that's how we'll calculate the probability of default. So 100 will equal, we have 104 multiplied by 1 minus our probability of default. That would be the no default, plus 41.6 multiplied by the probability of default, discounted back at 1.03. We'll call that the risk-free rate. I will explain the risk-free rate shortly. So all we have to do is just expand the numerator, cross multiply, isolate for POD. We'll get 1.6026. That is called a risk-neutral probability. Versus, let's say, an actual probability. And for this particular series of bonds, let's say it's a AA rated bond, we've looked in the historical record and we've seen that roughly 1% of them will default. Okay, well, let's say that we use the 1% then. 104, this is the probability of not defaulting, plus 41.6 times the probability of defaulting, and we'll discount it again at the risk-free rate. We get 100.365. We do not recover 100, we get 100.365. We're a little too high. Here's the problem. We want a method to allow us to arrive at the credit spread of a particular bond, for any bond that we come across. What we don't want to start doing is having to say, well, this bond has this type of risk, this bond has this type. Every bond has its own idiosyncratic risk. We want to use risk-neutral probabilities. Once we do that, and once we find what the risk-neutral probability is given what the risk-free rate is, we can use that for all bonds once and for all. Now, just so that we understand what's going on when we say risk neutrality, I'm sure you remember risk aversion, risk seeking, and risk neutrality. Let me make the argument on this side of the screen now for why we're going to use the risk-free rate, which we've used over here. We're going to use it over here, the risk-free rate, to discount any future cash flows, or, as we've done here, even to discount these particular cash flows. Let's say that we're given a choice between, and I'll just write it out in the corner here, we can take $100 today, or we can flip a coin, and we have a 50-50 chance of getting $200, or nothing. A risk-averse person would say, well, the expected payoff of the risky bet is 100. The expected payoff of the 100 here is the 100, but it has the lowest risk. A risk-averse person would take the 100. A risk-seeking person would say, well, I want to go where there's greater risk. For some reason, they get off on the idea of risk. They would take the 200. A risk-neutral person would say, the expected value of this is 100. The expected value of this is 100. I am indifferent. In other words, they're not even going to pay attention to risk. They're just going to look at the expected payoffs and select the one with the highest expected payoff, regardless of the risk. So if we're ignoring risk, what do we have? We have no risk, zero risk, risk-free. That's how we get to discounting future cash flows using a risk-free rate, is because we're neutral towards risk. However, we're not saying that we're neutral towards the time value of money. We still recognize that there is time value of money, but we don't associate any risk with it. We're just concerned with the expected payoffs. So we would use a risk-free rate to discount everything, simply because it reflects risk neutrality. So that's why we used a risk-free rate here. And in using a risk-free rate and solving for the probability of default, the probability we arrive at is called a risk-neutral probability. Let's look at our expected exposure here with that in mind. And let's take a 3-year 5% bond that we paid 104 for. So no default, we'll get a $5 coupon here. No default, we'll get a $5 coupon here. No default, we'll get our full 105. So on no default, we get 5, 105. On default, well, we get something, but it's not important that we know what it is. Let's say at this point in time, we want to calculate what our expected exposure is. Well, right away, we've earned the $5. We know that. So we could say, well, I've earned that $5. It's mine. I want the full $5. There'll be no discounting of that. I want the full $5 because this is our expected exposure, which means whatever we calculate is at this point in time. We're not going to bring it back to here. It is at this point in time. That 5 is at this point in time. But we have a 5 and a 105 into the future. So there's our numerators, 5 and 105. And we have to discount that back. Well, I've already made the case that since we're ignoring risk, we're going to use a discount factor that ignores risk. Well, that's the risk-free rate. We still believe in the time value of money. We just want to ignore risk. So we discount it back at the risk-free rate. This is the present value of any future cash flows because we could have sold it. Like, we could have sold that bond, so we want to know what the present value of that expectation is. Add them all together. That is our expected exposure. So we discount it at the risk-free rate. And our recovery rate applies to interest as well as principal. In other words, when we're figuring out our recovery rate, look what we do over here. It is what we have earned, the future cash flows discounted back at the risk-free rates, the full expected exposure, times our recovery rate. So if we figure we're going to get 60 cents on the dollar, we multiply everything by 0.6, not just the principal. All right, let's see if we can walk through a nice, easy example and do some calculations. What we're trying to get to, just so that you have your eye on the prize here, is we're trying to get to this, the CVA. And the CVA is what's called a credit valuation adjustment. So what we're going to do later on is we're going to price out a bond as if it were default free. Then we're going to calculate the credit valuation adjustment. Then we're going to take the difference between the two. If the bond were default free, it would sell for this much. Subtract the credit valuation adjustment. That must be the fair value of the risky bond. So let's take a really simple example where we don't have to calculate any intermittent cash flows. Let's just take a 5-year zero corporate bond. We'll make the risk-free rate 3%, probability of default at 1.25. Typically, the probability of default will be given. Keep in mind, this is a risk-neutral probability of default. We're going to be discounting any future cash flows at the risk-free rate, which is why we need a risk-free rate. So let's begin. The first thing we need are our expected exposures. Column number 2 over here. Notice for time period 0, we have no expected exposure because, well, we just bought the bond. Our expected exposure is whatever you paid for that bond. If we bought this bond for 80, that's our expected exposure on day 0. That's it. So our expected exposure must be at some point in the future. So our first one is time period 1, 2, 3, 4, and of course at 5. This is a 5-year bond. Notice what our expected exposure is at time period 5. It's the full face value because we've earned it all. I want it all back now. We're going to also assume here that our recovery rate is 40%. So let's see if we can't get this 88.8487. What is our expected exposure in 1 year? Well, let's draw out a timeline. Let's say here we are, there's year 5, and we want our expected exposure here. Well, there's no cash flow, so right away we're going to take 0 plus, and we have a whole bunch of zeros, but we do have this 100 in the future, but that's 4 years in the future. So we would have to discount it back for 4 years, right? And that's what we do. 1.03 to the 4 gives us 88.8487. This one, 91.52, I've calculated right below. T2 is 100 divided by 1.03 to the 3. This would be to the 2, to the 1, and then finally you have your 100. We can skip this column over here for recovery. It's just to show you all of the numbers that you can calculate. We actually don't need this column at all. We can actually skip it altogether. We don't really care what the recovery is. We only care what the loss given default is. So if our recovery rate is 40%, our loss severity is 60%. So we just take our exposure, wrong color there, our exposure, we multiply it by 0.60. There is our loss given default, 53.3092, and there it is right there, 53.3092. Multiply that by the probability of default, we get 0.6664, and there's the 0.6664. But notice that that is at time period 1. We want it today. We want the present value of the expected loss. So we'll discount it by 1.03. We get 6470. There's the 6470. Notice that there is a discount factor in here. And the discount factor is, notice I have the 0.6664. Well, if you take 6664 and you multiply it by the discount factor, you'll get 0.6470. That discount factor is simply just 1 over, whoops, wrong color again, 1 over 1.03, which is all this is over here. You can divide by 1.03 to certain powers, or you can just calculate all of your discount factors first. If you're doing this in an Excel spreadsheet, you typically have a column of all your discount factors first. It's the same thing, however you like to do it. Let's look at our second column and see if we can't recognize some of the numbers across here. We've already got our exposure, 91.5142. That matches. Multiplied by the 0.6, we should have a loss given default of 54.9085. There's our 54.9085. Multiplied by our probability of default. Well, what gives? How come it's 1.2344? What's going on here? How did we get the 1.2344? Well, all we have to really do is go back to level 1 quant and remember probability. Here's our tree. There is no default, there is default. And if there's no default, well, we can have another period where there's no default and there's default. And then there's, of course, no default and default, right? Well, we said default was 1.25%, which means no default must have been 98.75%. And of course, this is 1.25%, and again, this is 98, whoops, let's write it out, 98.75%, on and on we go. Well, if we want to know what the probability of default here is, this is at this 1.25 now is called the conditional probability of default. That's the probability of default given that you've survived one period. So to get the full probability of default, it's this probability multiplied by that probability. You just multiply the probability of each leg in the tree, right? So if you take 0.9875 times 0.0125, you should get 1.2344. And that's all we're doing here is 1 minus the 1.25% multiplied by the 1.25%. And we'll get 1.2344. So we'll take our loss given default multiplied by the probability of default in the second period. We get 0.6778. There's 0.6778. And you can multiply by the discount factor or discount it by 1.03 squared. You can satisfy yourself that this discount factor, 942596, is 1 over 1.03 squared. We get a present value of 0.6389, 0.6389. If you continue to do that and you add up all of the present values, you get 3.1549. That's called the credit valuation adjustment. That's a number that we need. Here's how we use that thing. Let's calculate the fair value of the bond assuming no default. We're going to get 100 in 5 years. We're going to discount it at 1.03 to the 5. That would be the fair value if there is no default. Notice that we're discounting at the risk-free rate. Why? Because if there's no default risk, it's risk-free, right? Minus the credit valuation adjustment. would give us 86.2609 minus a 3.1549. There it is there. Gives us 83.1060. If this was a default-free bond, it would sell for 86.2609. Given these characteristics, a probability of default of 1.25, a recovery rate of 40%, the structure of the future cash flows, our exposures, etc., this is the present value of our expected loss over the life of that bond. And that gives us the price of the risky bond, of a bond with default in it. All right, so we got that. That's step number one. Step number one, I shouldn't say step number one, it's many in a step, but that's a big conclusion we got to, is the fair price of the bond. Great. What's the credit spread? The credit spread is the yield to maturity on this bond minus the risk-free rate, which is 3%. And our yield to maturity, if we bought this bond at 83.1060, our yield to maturity is 3.7704. How did I get that? Well, N is 5, our payment is 0, our future value is 100. There's our PV, negative 83.1060. Solve for your yield to maturity, you get 3.7704. If the risk-free rate is 3%, there's your credit spread, 0.7704. Now, as we said on the first screen, we're attributing the entire spread to default risk. To credit risk. We're attributing the entire spread to that. Even though we know that in that spread, there might be some liquidity differences because a government 5-year bond is far more liquid than a corporate 5-year bond. Well, there'd be even if the 5-year corporate bond was default free, just because of its liquidity, there would be some extra yield associated with that bond. There would be a spread on that bond just for that purpose alone. The second thing that could be in that spread is taxation issues, because a corporate bond might have the income off the corporate bond might be taxed differently than a government bond, which may be exempt from, let's say, a state or a provincial tax, but not a federal tax, or may be exempt from a federal tax, but not a state or provincial tax, right? So there we go. All right, this is our last screen on this learning objective. Then we'll go through examples 1 and 2. Here what we're doing is we're just calculating a whole bunch of internal rates of return, and the internal rate of return is nothing more than the yield to maturity, assuming a default at the end of each particular period. So if there was a default after the first period, we paid 83.1060 for the bond. Our recovery is going to be 35.5395. Divide that by 1 plus IRR, solve, negative 57.24%. If it's at the end of the second year, we still paid 83.1060 for it, but notice our recovery is 36.6057 divided by 1 plus IRR squared, which is, because this is a zero coupon bond, it's the same as saying 0 over 1 plus IRR, that's the first coupon, and 36.6057 over 1 plus IRR squared, negative 33.63. And if we go all the way to the end and we actually get paid, we already saw that it was 3.77%. So your annual rates of return, depending on when and if default occurs. So we can calculate a series of those. Let's take a walkthrough for example 1 and 2 here. All right, example 1. Example 1 is really a very simple example. It doesn't go into any of the detail that we just went into. But there's a peculiarity in the way that they calculate the loss given default. So I sort of anticipate questions, and rather than answer a bunch of questions online, I thought, well, let's just do example 1 and explain the peculiarity that they're using. And only in this example do they use that particular peculiarity, which I find it odd that they would put that in there without explaining how they did it. So let's just go. A fixed income analyst is considering the credit risk over the next year for 3 corporate bonds currently held in her bond portfolio. Her assessment for the exposure, probability of default, and recovery is summarized in the table. Here's exposure per 100 of par value, A, B, and C, 104, 98, and 92. And you have your probability of default, 0.75%, 0.9%, and 0.8%. And here's our recovery per 100 of par value. And this is what makes it a little bit confusing, because your exposure is given per 100 of par value and your recovery is given per 100 of par value. So we just have to We just have to calculate our loss given default. Just a little bit tricky here. Although all three bonds have very similar yields to maturity, the differences in the exposures arise because of differences in their coupon rates. Based on these assumptions, how would she rank the three bonds in terms of credit risk over the next year, highest to lowest? And to do this, we'd like to know, well, it's simple enough. What's our expected loss? And we'll just take the one with the lowest expected loss, the next one with the next highest, and then, of course, the highest expected loss. We'll just rank the three that way. She needs to get the loss given default for each bond and multiply that by the probability of default to get the expected loss. The loss given default is the exposure minus the assumed recovery. And here's the how they do it. Bond A has an exposure of 104. The assumed recovery is 40 per 100 of par value. So we're assuming we're going to get 40 back on this one. Not 40% of the 104, just 40 back on that one. So 104 minus the 40 gives us 64. Multiply that by 0.75, we get 0.48 as our expected loss. For the next one, we have 98. Our recovery is 35, so 98 minus 35 bucks gets us to 63, and this is 92 minus 30 gets us to 62. Another way of getting to this number of 63 to understand how we're getting to this 63 is if we're going to recover 65 or 35 per 100, we're going to lose 65 per 100. But since this is 98, it's 2 short of 100. So we're not going to lose 65, we'll lose 63. It's just odd that the way they did it this way, without much explanation as to why, because it stands in contrast to every other example and the way it's done in every other example. So I don't want you to think that this is something that you have to recognize and remember. Just, I don't think it's really a big deal. I think it's just a little peculiarity of how they did the example. So there we go, 63 times 0.9 and 62 times 0.8. There we go. So our lowest one is A at 0.48. Next would be C at 0.49. Then you have B at 0.567. All right, example 2. A fixed income trader at a hedge fund observes a 3-year, 5% annual payment corporate bond trading at 104 per 100 of par value. If you recall in one of the earlier slides I did, I used this as an example. The research team at the hedge fund determines that the risk-neutral probability of default used to calculate the conditional probability of default for each date for the bond is 1.5%, given a recovery rate of 40%. Well, I said the risk-neutral probability of default will be given to you. Typically, it will be given to you in the question. The government bond yield curve is flat at 2.5%. So there's our risk-free rate, 2.5%. It's telling us it's flat. Now, it doesn't have to be flat. We could have an upward sloping curve, in which case, well, we have the uncomfortable position of having to discount each cash flow by its respective spot rate. So typically for these questions, because that's just a lot of tedious work, and we get it, we know how to do that, that's not really the point we're trying to make here. So let's just make a flat government curve just to get all of that stuff out of the way of the learning, right? So there's the flat curve. Based on these assumptions, does the trader deem the corporate bond to be overvalued or undervalued? By how much? If the trader buys the bond at 104, what are the projected annual rates of return? So that's a fairly typical question. So how would we begin on this? Well, we have to get to the CVA. We'll price the bond out as if we're default free. We'll subtract the CVA and we'll see what the fair value of the bond is. Is it 104? Is it greater or less than 104? From there, we'll determine whether or not we want to buy it. So let's go. To do that, what do we need? We need our exposures first. So here's our exposures. So let's look at how we get this first number, the 109.8186, and here it is right here. After the first year, we've earned $5. That's ours. We've earned it. We don't have to discount that. We've earned it. And by the way, it's the expected exposure. So in 1 year from now, that's exactly what it would be. No need to discount something to 1 year when it is 1 year, right? Then we still have $5 for the second year and $105 for the present value. Notice that we're discounting it by the risk-free rates because we're risk neutral at this point. And we get to 109.8186. To get to the next one, we would just say, okay, well, what do we have at that point in time? We have $5 plus we would just have this last term, the 5 over 1.025 for 1 year, and it would be discounted there. And finally, in our third year, what do we got? It's 5. I've earned that 5 for the third year that I've held it, plus give me my principal back, the 100, right? There's the 105. Here's our recovery, 4.3, 4.2, and 4.2. Again, we don't really need the recovery. It's sort of a useless column in there. So you can just, if you're calculating or trying to get to the CVA, you can skip right past that and say, well, if it's 40%, I'm just going to multiply the exposure by 60% to get my loss given default. Then I'll multiply by my probability of default. Notice we have 1.5, and then it drops because the next probability would be 0.985 times 0.015. Then this term over here would be 0.985 times 0.985 times 0.015. Loss given default times the probability of default. You can skip over this. This is our expected loss. Here's our discount factor, or you could just divide it by 1 plus the risk-free rate to whatever power. Here's our present value, add them up. There's the CVA, 2.72222. All right, so now we have our credit valuation allowance. Let's price this thing out as if it were default free, subtract that, and see what we get. So here we are here. Therefore, the fair value of the bond, oh no, first of all, let's I just jumped right over the calculating of the default free price. The credit valuation adjustment for the bond is 2.7222. The sum of the present value of the expected loss. If this 5-year 5% bond were default free, its price would be 107.1401, and we just discount each of the cash flows by the risk-free rate because it is default free. We get to 107.1401. Therefore, the fair value of the bond, given the assumed credit risk parameters, is 104.4178. That is the price of the bond with no default minus a credit valuation allowance. We get to 104.4178. And up here, we're told that it's priced at 104. So the first thing that we're being asked, is it overvalued or undervalued? It should be 104 and change. It's 104, so it appears to be undervalued in the market. By how much? Well, we can see how much it is right now. We deem this corporate bond to be undervalued by 0.4178 per 100 of par if it's trading at 104. Last part was to determine what the rates of return were on this particular bond. The projected annual rates of return for default on dates 1, 2, and 3 are negative 57, negative 33, and negative 22 respectively. If there is no default, the rate of return is 3.57%, which is the yield to maturity. So how do we get that? Well, here is 1.04 equals, this is 43.9274. This when I said that the recovery column really doesn't add any value, I should have been more clear. It doesn't add any value in getting to the CVA, but this column is useful for determining what our internal rates of return are, or what our yields to maturity are, given default at each particular time period. So if it defaults at the end of the first year, our internal rate of return is negative 57.76%. If it defaults at the end of the second year, it's negative 32.27. Defaults at the end of the third year, it's negative 23.23. And if it doesn't default at all, it's 3.57%. All right. LOS-B, explain credit scores and credit rating. So credit score, this is used for in the retail lending market for individuals, small owner-operated businesses. It ranks a borrower's credit riskiness but does not provide a probability of default. Credit ratings, used in the wholesale lending market. It ranks the credit risk of a company, a government, or an asset-backed security. There are 3 major credit rating agencies: Moody's Investor Services, Standard & Poor's, and Fitch Ratings. Ratings are broken down into 20 categories. There are 10 categories of investment grade ratings and 10 categories of non-investment grade ratings. Investment grade is typically shortened to IG. Non-investment grade rating is typically denoted by HY for high yield. Ratings belong to both an issuer and issues. So company ABC will have a credit rating, and the credit rating for ABC is typically for senior unsecured debt, but every credit issue that the company issues will have its own credit rating. So even though the company could have a credit rating for senior unsecured, the company itself could have a very secured bond that's issued and have the issue with a credit rating higher than the issuer's credit rating, or it could be junior or subordinated debt, which would have a credit rating lower than the company, because the company's rating would be typically for what senior unsecured debt would be rated at in the market. The companies issue a letter grade plus an outlook, as well as when the issuer is under watch. So the outlook is either positive, stable, or negative. So you could have a company that is rated A, stable, or A, negative, under watch, or A, stable, under watch. Under watch means it's stable right now. No need to change it, but just know that we're watching it because, well, you know, we're a little uncertain. All right, we're on our next learning objective. We have to calculate the expected return on a bond given transition in its credit rating. And to do this, we need a transition matrix. The reading gives us a transition matrix for a 10-year corporate bond. So let's first of all figure out how we're going to read this thing, and then we'll start to use it. The first column down here is where we would find our current bond, and the first row is where our current bond could be upgraded or downgraded to. We call that credit migration. So let's say we're holding an A-rated bond. Well, there it is. This is the from column. From A to anything. Once we find our bond A, all we care about is the row across. Now let's read these rows. These are all probabilities. This first one is 0.05%. So it's not 5% as in 0.05, but 0.05%, almost non-existent. That's an upgrade from A to AAA. Upgrading from A to AA, 2.5% probability. Look at this, 87.5% probability that nothing's going to happen. That an A bond will stay an A bond at the end of the year. And these are all probabilities across here. So let's think about what we did in level 1 when we looked at the price sensitivity of a bond to a change in yield. Because if credit spreads change, and the credit spread is part of a corporate bond's yield to maturity, it's the same thing as the yield, its own yield changing. Well, how did we calculate that? We used negative modified duration times the change in yield. Nothing changes here. We're going to do the same thing. So we need some value for modified duration. We're going to use a modified duration on a 10-year bond at the end of the first year. So here we are. Let's assume a 10-year corporate bond will have a modified duration at horizon end of 7. Let me finish filling this in. 7.2. We're going to use 7.2 at the end of the first year. So there's the first one. Now we just need change in yield. How are we going to get that? Well, this is our last row in the transition matrix, is the yields. So what this is saying, if we look at A and we follow it all the way down, 1.1, that is saying that an A-rated bond should have a credit spread of 1.1%. If it gets upgraded to a AA, it'll have a credit spread of 0.9%. So there's 20 basis points that the credit spread has decreased, which means it's the same as saying that the yield to maturity for this bond will decrease by 20 basis points. When the yield decreases, the price rises. So let's have a look. Let's say we migrate from A to AA. That's an upgrade. Negative modified duration times the change in yield. Negative 7.2 times, it's 0.009 minus 0.011. There's the change in yield. It will be 0.009. It was 0.11. Notice that this will give us a negative value in here. A negative times a negative gives us a positive. And we should expect a positive because we have an upgrade. A to BBB, well, let's look down BBB. BBB has a credit spread of 1.5%, so it'll be 1.5% minus 1.1. Notice that this will be a positive value in here because the yield to maturity is increasing. Negative 7.2 multiplied by an increased change in yield. We have a drop in price. Negative 2.88%. That makes sense. We had a downgrade, A to BBB. A all the way down to B, negative 38.88%. So we can calculate each of these credit migrations for each of the bonds or each of the credit ratings that we have. But we want to calculate an expected return for the bond as a whole, regardless of any one particular migration, but just any transition at all. Well, we need two things to do that. Well, we need this row. This gives us all the probabilities, right? So we just multiply the probability by the amount of the change that we would get, and this is what we calculated right here. So 0.05, and we would calculate a transition from A to AAA the same way we did here, negative 7.2, and it would be 0.6% minus 1.1, and see what we get. Then the next one is 2.5. There's a 2.5% probability that A will transition to AA. 87.5% probability that nothing will happen, and we just keep going along, and here's what we get, negative 0.6342%. So our expected return will be our yield to maturity minus the 0.6342%. Really simple. Let's do a walkthrough of example 4. Example 4 is an example just like this. So here we are, example 4, the impact of credit migration on expected return. Manuel Perello is a wealth manager for several Latin American families that seek to keep a portion of their assets in very high quality corporate bonds. Mr. Perello explains that the yields to maturity on bonds should be adjusted for possible credit spread widening to measure the expected rate of return over a given time horizon. In his presentation to one of the families, he uses a 10-year AAA rated corporate bond that would have a modified duration of 7.3 at the end of the year, using the corporate transition matrix in Exhibit 7. And Exhibit 7 was, if you go back to the previous screen, the matrix that I had replicated from the reading. That's Exhibit 7 there. So you can find Exhibit 7 in your reading. Just hit pause, find it, and you'll use it for this example. Mr. Perello concludes that the expected return on the bond over the next year can be approximated by the yield to maturity, less 32.5 basis points to account for a possible credit downgrade, even if there is no default. Demonstrate how he arrives at that conclusion. So we need two things. We're going to need, we don't need two things. We need several things. We need the modified duration at the end of the term. We're told it's 7.3. We can calculate all of the possible credit migrations, and we'll come up with a percentage change in price. Then we will weight all of those by the probability of it occurring. So let's go from AAA to AA. There's a notice all the way down for all of them. It's all negative 7.3 because it's the same number. And the second term in the brackets here should be the same value as well, 0.6, which is the credit spread on AAA. And then the first term in every bracket should be the credit spread for each of these particular ratings. AA is 0.9, A is 1.1, triple B is 1.5, double B 3.4, etc. And calculate them out. And then all we have to do is just weight them by their probability. So if we look at the first row in that matrix, AAA to AAA, there's a 90% probability that nothing will happen. Well, there's the 0.9 multiplied by 0%. Next, we have the 9% probability that there'll be a change, and we've already calculated, of negative 2.19. So notice that's 0.0900 times the change or the percentage change in price. And we weight each one the same way. Look what we get, negative 0.3249 or negative 32.5%. That's 32.5 basis points. And in here it's saying the yield to maturity less 32.5 basis points, and that's what we get. All right, next LOS is to explain structural and reduced form models of corporate credit risk, including assumptions, strengths, and weaknesses. And the reading makes a point of saying that the math behind each of these models is beyond the scope of the reading. You are lucky. Previous years had to do it, had to go through the structural model and the reduced form model, and the math is ugly. So all we really have to do here is just describe what's going on. And that's really simple to do. So let's say we'll start with the structural model. Let's say a company defaults on its debt if the value of its assets falls below the amount of its liabilities. So let's say that a company has a bond owing of $1,000. And at the end of the period, when it comes time to pay that bond, the value of its assets is $700. Well, would you pay the $1,000 if the value of your assets are $700? The structural model makes the assumption of saying no. All you would do is you turn over the assets to the bondholders and say, oh, well, there you go, we're done. The probability of that event has the features of an option. So this right here is the balance sheet identity. Assets equal to debt plus the equity, right? And capital T is at time T. Here is time T over in our chart over here. We'll explain this chart in a second. So assets equal to debt plus the equity. The equity we can think of having a payoff as the maximum of either AT minus K or 0, K being the value of the debt. And we can think of that as a strike price. That's just the value of the debt. So if the assets are $1,300 and we owe $1,000, that's $300 or 0. So the equity clearly is worth $300. The way to do it, or the way to see it, using the identity is saying if the assets are worth $1,300, it has to equal the value of the debt plus equity. Well, our equity would be 300 at that point in time. So our equity is the maximum of AT minus K or 0. Well, that's the payoff to a call. So we can think, at least the structural model says, think of equity as a call option on the company's assets. And if equity is a call option on the company's assets, maybe with that option analogy, we can use Black-Scholes-Merton to price out what we're looking for here, to price out the amount of credit risk in a particular bond. Debt is equal to the value of the assets minus the maximum of either AT minus K or 0. So let's say, just to understand how that works, let's say that the assets are 1,300, and let's say the assets are 700. And let's see what this value gives us. At 1,300, we would have 1,300 minus, it's the maximum of AT minus K. This would be 300 or 0, so it would be 300. 1,300 minus 300 is 1,000. So we would pay the debt. The debt would get 1,000. Let's say it were 700. It would be 700 minus the maximum of AT minus K. Well, 700 minus 1,000 is negative 300 or 0. What's the maximum number? 0. So it would be 700 minus 0, which is 700. The debt holders get the value of the assets. Okay, so what is this over here? If we can conceive of this in terms of an option analogy, we can figure out what the probability of default is using a Black-Scholes-Merton model, which assumes a log normal distribution. So here we are today. Let me change the color here to something that we can see. Here we are today. Here's the value of the debt. Let's say it's 1,000. Here's the value of our assets today, A sub t. And off we go. And it models the variability. We need some kind of estimate for the volatility of the assets. And off it goes. And at some point in the future, this is the distribution of the value of the assets that we would get. And this is the mean value of the assets. Now look what I'm going to do here. This is the asset value increasing at the risk-free rate. And over here is the probability of default because it falls below the default barrier, which is 1,000. So we can use Black-Scholes-Merton to model what the probability of default would be once we can conceive of this, of equity as a call option on the assets. The assumption that we have to make here is that the company's assets are actively traded, because we need to have some visible market price for the value of the assets and some volatility on the assets. That's not really a viable assumption in a lot of cases. Asset value has a log normal distribution in this model as well, and default depends on the structure of the balance sheet. By that we mean default depends on the assets versus the liabilities. Whatever the structure of the balance sheet is, that determines default. AT greater than DT, there'll be no default. The asset value at time T. Time T is when we have to pay off the debt. Greater than the assets value greater than the debt value, or asset value less than the debt value, will determine whether or not we pay off the debt. What the structural model is getting at is that default is endogenous. We really only need the structure of the balance sheet to model the probability of default. Does that sound logical to you? It does in a little bit of a way. Say, well, of course. I mean, if the asset value is going to be higher than the value of the debt at some future time, we'll pay off the debt. If it's not, we won't pay off the debt. Some companies have volatile assets. Some don't have volatile assets. We can sort of make assumptions about these things. But does this statement make sense to you? Default is endogenous. Nowhere in here do we consider the business cycle. Wouldn't the probability of default fluctuate with changes in the business cycle? If we expect a bad economy, let's say if this was our expectation for what the asset value would be at time t, and we expected a recession to happen somewhere here, wouldn't that change the trajectory of the asset value? Well, the structural model doesn't consider that. That's kind of a limitation of the structural model. Also, some more limitations. It requires estimates of the asset value and of the volatility of the assets. Well, these are non-observable for most companies. It also assumes that the value of the debt that you're modeling is as reported on the balance sheet. Well, there could be other sources of debt that we don't find on the balance sheet. We know that we can use structured finance vehicles to move debt off the balance sheet. We can use different types of lease structures to have off-balance sheet financing as well. So those are sort of some of the drawbacks of the structural model. All right, let's just sort of describe the reduced form model. Here, rather than default being endogenous and depending on the structure of the balance sheet, default is an exogenous variable that occurs randomly over a period of time. So the reduced form model seeks to explain when default occurs, not so much why default occurs. And that is a disadvantage of the reduced form model because it doesn't answer the question of why default would occur, whereas the structural model does explain why default would occur. Well, the asset value is less than the debt that we owe. Forget it. I'm not paying. Default time is modeled using a Poisson stochastic process, for those of you who want to know a little bit more about that. Here are some of the nice things about the reduced form model. The inputs are observable. Default intensity is estimated using a regression analysis on company-specific variables, things like leverage ratio, net income to assets, cash to assets, etc., whatever you find is useful, and macroeconomic variables, unemployment, GDP, growth rate. In the more mathematical treatment of the reduced form models, this vector is called lambda, and lambda is a vector of macroeconomic variables, and it's used directly in the calculation of default intensity. So it is tied to the business cycle, which makes the reduced form model kind of attractive that way, saying that there is something about the default intensity that is related to the state of the economy, and we know that defaults on debt are related to the state of the economy. So I think I like that a lot better, right? Default intensity varied depending on company performance and the business cycle. Assumes at least some of the company's debt trades. Well, that's not an onerous assumption either. The structural model assumed that the company's assets traded, because we had to think of equity as a call option on the assets, so the assets had to trade and it had to have a volatility. Here, for the reduced form model, we're saying, look, at least one of the company's debt securities trades in public markets. And basically, I've drawn out sort of a kind of funny looking business cycle here, but this is the result that you would get with a reduced form model is that as the economy is improving, you would have a lower probability of default, and not only that, also a lower expected loss if there was a default. And as the economy sinks into a recession, what happens is you end up with higher probabilities of default along with higher amounts of expected loss. That's really all you have to know in this particular version of this reading for the structural model and the reduced form model. You're getting off very light. Previous years, the entire reading was on the structural model and the reduced form model. And when I say the entire reading, I mean the entire reading. It was considered a very brutal reading to get through. Now it's a breeze. All right. Here's the heart of the reading, this learning objective. Calculate the value of a bond and its credit spread, given assumptions about the credit risk parameters. And to do this, we're going to introduce volatility, and we're going to use a binomial interest rate tree to determine what the value of a credit risky bond would be. So, before we do that, let's just do a quick review on how we move from par to spot to forward rates, just so that we're not confused about where these rates are coming from. If you don't need this review, then you could just skip ahead. Probably about 6 minutes is probably all I'll need. So let's say that we observe a bunch of par bonds, and notice the price here is all 100, and these are the coupon rates on the bonds, so these are par rates. And we need, if we're going to construct a binomial tree, we need to get all the way over here to the forward rates. So we need to figure out what our spot rates are first, and then from our spot rates we can move to our forward rates. So look at our coupon rate. This is rather interesting because we actually have a negative coupon rate. How do we deal with the negative coupon rate? So this is maturity of 1 year. We have a negative coupon rate, price of 100. So 100, our future value will equal 100 minus the 0.25. Typically it's 100 plus the coupon. Well, plus negative 0.25 is minus 0.25 times the discount factor 1. And if you don't like discount factors, it's the same thing as saying it is 100 minus 0.25 discounted back by 1 plus r, and then just solve for r. Well, 1 over 1 plus r, if you separate it out, is your discount factor. So that's all we're doing, is we're just going directly to a discount factor. Well, this is easy enough just to isolate. We'll get 1.002506. To get our second discount factor, notice here it's 0.985093. Well, we have a par bond coupon of 7.75%, so we're going to get 75 cents multiplied by discount factor 1, or if you like it better this way, 0.75 discounted by 1 plus r, plus 100 plus our coupon multiplied by our discount factor 2, and we solve for discount factor 2. And we just keep going all the way down. You can satisfy yourself that the last one here is 2.75 times discount factor 1, 2.75 times discount factor 2, discount factor 3, discount factor 4, and then here's our final payoff times discount factor 5. By this point, we would know all of these discount factors. We solve for discount factor 5. Once we have our discount factors, we can determine what our spot rate is, and our spot rate is just 1 over the discount factor minus 1 for the first year. Actually, it would be to the inverse of whatever year it was, so it would be 1 over 1 in this particular case, minus 1. Yeah, it should not be surprising. We should have recovered that, right? 0.25. For the next year, it's 1 over 0.985093. We take the square root of that, or the power of 1/2 minus 1. There we go, 0.7538. These are our spot rates, by the way. To get the next one, 1 over, what's our discount factor? 0.955848. And since it's for 3 years, we would take the third root, or to the power of 1 over 3 minus 1. We get 1.5166%. And of course, the last one over here, I skipped the fourth one in case you're looking for the fourth. I just ran out of room. There we are. Now we need our forward rates. Well, we have discount factors. We can calculate our forward rates directly from our discount factors. And of course, there is no forward rate for the first rate because it is the spot rate, right? F01 is the spot rate. So F11 is the 1 year rate 1 year from now. All we do is we just take the ratios of the discount factors. So it would be 1.0025 divided by 0.98 minus 1. There we go. The next one would be 0.98503 divided by 0.955848 minus 1. Again, the next one is just the ratio of the two discount factors, and there we go. So moving from your par to your spot to your forward rates, you can use either discount factors to get there, or if you don't like discount factors, you can use 1 over this kind of notation. It's more onerous to go through all of that notation, but you can satisfy yourself that doing that is the same as using all of the discount factors. All right, so here is a binomial interest rate tree. It's given to us. It's already calibrated. You will never have to calibrate an interest rate tree on an exam. It'll always be given to you. But we need these numbers in brackets. These are all percentages or probabilities. So what we have here when we first start with our first rate, we have a 50% probability of rates going up, or 50% probability of rates going down. And from this point again, every one of these branches has a probability of 0.5. Every single one, 0.5. So how do we get here? Well, we have a 50% probability of getting to here, multiplied by a 50% probability of getting to here, to here, to here. So this is 0.5 to the 4. You'll get 6.25%. The probability of obtaining this node is 6.25%. We're going to need these probabilities. The probability of obtaining this node is 0.25 or 25%. How is that? Well, there are 4 pathways here, right? Up, 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 down, up, up, down, up, up, down, up, and down, up, which I've written out here. So if there's a 6.25% probability of getting to one of these n nodes and 4 ways to get here, it's 0.0625 times 4. There are 6 ways to get to this particular node, so it's 0.0625 times 6 for 37.5. So all these are in brackets are just probabilities of actually landing in that node. We're going to need those, so we need to know exactly how we got to those. We're going to do a walkthrough through two exhibits right now, Exhibit 11 and Exhibit 12. Exhibit 11 is going to show us something about a 2.75% annual pay 5-year government bond. And then we're going to look at a 3.5% annual pay 5-year corporate bond. Notice we're looking at a 5-year government bond and we're looking at a 5-year corporate bond. Look at the difference, 2.75 to 3.5. Now, we're going to look at this 3.5% corporate bond assuming no default. We're going to come up with a price. Then we're going to say, all right, how do we calculate the CVA? We still need to calculate the CVA. Remember, go back to Learning Objective A. What was our goal there? We want to get to that credit valuation adjustment. So we want to calculate the price of a bond assuming no default. Then we're going to calculate the credit valuation adjustment. Then we're just going to subtract the two. All right, here's Exhibit 11, valuation of a 2.75% annual pay government bond. And it's going to be a par bond, as we can see right here. It's a par bond because the 5-year par rate, we're going to use the same rates throughout the reading. The 5-year par rate was 2.75%. So we should have a par bond, and we do. And you've already been through the reading on pricing out a bond using the tree. We start at this end of the tree and we price back one note at a time. Then to get the value here, this 93.3105, it's 50% of this value plus 50% of this value, add on the coupon, and then you discount it by whatever interest rate happens to be associated with that note. And you just keep going backwards till you get to the end. This is actually interesting to see how they handle a negative rate. Notice that the preceding values were 95.7, it's hard to see, 7258, and we have 98.27, both under 100. And we're discounting backwards. So even after you add the coupon on, when you discount backwards, typically you would expect a lower value. But because this is a negative amount, it is like taking these values here and compounding them. So they actually would grow over that 1 year as opposed to being reduced by the amount of the interest rate over time. They're actually growing by the amount because you have a negative rate. So it's interesting to see how negative rates are actually incorporated into the tree. Let's have a look at the next one. Exhibit 12, the one we're going to, is a 3.5% annual pay corporate bond. It's not a government bond, it's a corporate bond, but it has a 3.5% coupon. This is a 2.75% coupon. We get par. In the next exhibit that I show you, Exhibit 12, we're going to price out that 3.5% corporate bond as if it were default free. We should get a premium bond. Let's just scroll down and see how we do. There it is here. Here's the value of 3.5% annual pay corporate bond. Notice we have the same rates. It's the same interest rate tree, and we're pricing this out as a 3.5%. Notice that we get a premium bond, which we should get a premium bond. Now, I always stress that it's important every time you get to an exhibit to read the title of the exhibit to know exactly what we're looking at, right? This is the value of the 3.5% annual pay corporate bond assuming no default, and they shorten it to VND, value no default. I use PV, and in brackets I use ND. So if you see me using PV for present value and then in brackets ND, that means no default. The reading will use VND to signify no default. But we want to be clear that that is the value that the bond would have if there was no default. That is a step we have to take to value a corporate bond with default, is we have to first say, well, what is the value of the bond if it has no default? Then what we're going to do is we're going to find the credit valuation adjustment, which we've already seen how to do, and we're going to do more of that, and we just subtract it from the value of the bond with no default. So there's our first starting position, is 103.545. From that, we will subtract the credit valuation adjustment. Okay, we know that to get to the CVA, the first thing that we're going to need are the values of our expected exposures at each of the future dates. We don't need anything at date 0, but we need an expected exposure at date 1, 2, 3, and 4. So we do need this tree. We do need to populate the tree. So pricing this out in terms of arriving at all of the values in the cells as if we were pricing out a default free bond is an important first step, because we need all these values. See the 96.4659, the 97.6692, etc. So for date 4, all we're concerned about is this column right here. and we want to know what is our expected exposure as of that date. And the question would be, well, for which path of interest rates? This cell, this cell, this cell? And my answer is for all of them. Remember when we first did the tree to get the interest rates, we put a probability into each cell of the probability of reaching that cell. And we found that the probability of getting to this top cell in the column for date 4 was 6.25%. The probability of getting to the next cell was 25%. This was 37.5%. This was 25%, and this was 6.25%. So all we have to do is weight each of the values by those probabilities and add the coupon. So here we go. 6.25% chance of arriving at this cell, which has a value of 96.4659, plus we have a 25% chance of arriving at this cell with a value of 97.6692. 37.5% probability of arriving at this cell that has this value, 25% probability here of arriving at this value, and a 6.25% probability of arriving at this value, and then we add our coupon. There's our expected exposure. When we go to the third date, we saw that there was a 12.5% probability of landing here, 37.5% probability of being in this cell, 37.5% here, and 12.5% here. So we just weight each of those values by those probabilities and add the coupon. For date 2, we saw that there was a 25% probability of being in the upper cell, 50% probability of being here, and 25% probability of being down here. So we weight each of the values by those probabilities and add the coupon. For date 1, I've already done it down here. There's a 50% probability of landing in this cell, 0.5 times 98.492, plus a 50% chance of landing in the bottom cell, 101.0803, and add the coupon. There's our expected exposures. So we need all of our expected exposures, which means we need the tree, but we needed to arrive at a value for this bond, assuming no default, so we would have populated the tree with the values anyways. All right. Move on. All right, let's calculate the CVA. We've seen this table before. Here are all the expected exposures, and we calculate them the way I showed you on the previous screen. Loss given default, we're multiplying the expected exposure by 60%. We're assuming a recovery rate of 40%. That's fairly consistent throughout the reading. It's just to assume a recovery rate of 40%. Multiply our expected exposure by 60%. Once we have our loss given default, multiply the probability of default, and multiplied by the discount factor to get the present value of the expected loss. So to say that again, this is our loss given default. This is the probability of actually experiencing that. So if we multiply the two together, we'll get an expected loss. But we want the present value of the expected loss, so we take the expected loss and we multiply it by the discount factor, which, again, I'm going to say again, is the same as discounting it by whatever the risk-free rate was for that period of time. So you can divide it or you can just multiply by a discount factor. You'll get the present value of the expected loss, 77.66. For the next year, year 2, that was our expected exposure. We multiply that by 0.6 to get a loss given default. Our probability of default is 1.2344 because we're calculating it this way, which looks like this, right? This is the probability of no default multiplied by the probability of default. So probability of default is 1.25%. The probability of no default was 98.75% to get 1.2344. And for the next period, we would just multiply no default by default, etc. And that's how we get these rates in here. Multiply that by the discount factor. There's the present value of the expected loss. Add up all of the present values of the expected loss. We get to 3.5394. That's the CVA. So here's what we need over here. The fair value, assuming no default, we calculate at 103.5450 minus the CVA, which we just did here, 3.5394. There's the fair value, assuming default 100.0056. N equals 5. This was a 5-year bond. Future value is 100. Our payment is 3.5. We know what our present value is now. We just calculated it, so we can calculate what the yield to maturity is on this bond, 3.4988. So now we can calculate our credit spread. 3.4988. Remember, we were looking at a 5-year government bond. We priced that out first in Exhibit 11. We got a par bond. 2.75% par bond. So 3.4988 minus 2.75, there is our credit spread, 0.7488. All right, this is just an extra screen that I put in, just itemizing the steps that we've been through so that we don't get confused about where we've been and how we arrived at the credit spread. So we're going to observe par rates perhaps. We need to turn them into spot rates and then forward rates. Perhaps we're already given the par, the spot, and the forward. Really all we care about is the forward rates, the first spot rate and the forward rates. From that, we'll construct an interest rate tree using the forward rates. Perhaps we're already given the interest rate tree. We have to calculate the present value of a risky bond assuming no default. So we calculate the present value of the corporate bond assuming no default. We then calculate all of our expected exposures multiplied by 1 minus the recovery rate to give us our loss given default, which is here. Multiply our loss given default by the probability of default. That will give us our expected loss multiplied by the discount factor. That will give us the present value of our expected loss. We sum all of those up and we'll get the credit valuation adjustment. So this will give us the credit valuation adjustment per year. The sum of them all will give us the credit valuation adjustment. So it's the present value assuming no default minus the sum of the credit valuation adjustments gives us the present value with default. Once we have this, we can find the yield to maturity. We just key into our calculator N, payment, the future value, and the present value, which happens to be this amount that we just arrived at. We'll get a yield to maturity. Take that yield to maturity and subtract the maturity matching government yield to maturity, or, to say it more correctly, the maturity matching benchmark bond yield to maturity, because it may not be a government bond. And that'll give us our credit spread. And this credit spread assumes that the spread is based entirely on credit risk. Note, increased volatility will change the structure of the interest rate tree. However, it has an insignificantly small effect on the CVA. It will affect a bond with an embedded option. Increased volatility does do that. But as far as the CVA goes, it's an insignificantly small difference on the CVA, only because of the lack of symmetry in the interest rate tree when interest rates change. Those rates at the top of the tree will change by more than the rates at the bottom of the tree. Remember, it's a log normal distribution, right? So it's volatility. We can conclude that volatility has almost zero effect on the CVA. Pennies overall, if even that. So we can really sort of just ignore the effect of volatility on the CVA. It should not affect the CVA in any significant way whatsoever. All right, let's have a look at using a floating rate note instead of a fixed coupon note. We just did the 3.5%. Now we're going to do a floating rate coupon. And this floating rate coupon is the index, whatever the benchmark index is, plus 50 basis points. And we're going to assume 10% volatility in the tree. So value a floating rate note paying the benchmark rate plus 0.5%, assuming no default and 10% volatility. And here's what it looks like. A couple of things we got to point out here, because to get the CVA, the credit valuation adjustment here, is a little bit different in the first step, getting our expected exposures. A little bit different. Kind of the same, but a little bit different here. Notice that on the fifth date, we have different maturity values, the maturity value plus coupon, depending on where we end up. If it were the fixed rate bond, all of these would be 103.5 all the way down. If it were the 3.5% coupon, 103.5 all the way down. So our expected exposure would be easy to calculate. It's 103.5. But these are all different. All of them are different. And this is the value with the coupon in. That's the value with the coupon in. So what we're going to do for this last row is we're going to take the probability of arriving at that value, which is just the probability of arriving at the cell before it. So there was a 6.25% chance of getting here. We had, I think, 25% chance here, 37.5, 25, and 6.25. So we're just going to weight all of these. We don't have to worry about adding any coupon in because the coupon's already in. Nothing new there. We've seen that before. When we get to date 4, though, we got a bit of a problem because there's a probability of arriving at this cell, and this cell, and this cell, and we've already seen that. But this interest rate is associated with this cell over here. So the probability of having this interest rate is associated with the probability we observe here, not the probability we observe up here. The value in this cell depends on the probability of landing in this cell. The coupon value we add on depends on the probability of arriving at this cell for that interest rate. So we have to weight all of the values in this column by their probabilities, and then to that we add a weighting of all of the coupons, but we use this column's probabilities. And then when we get to date 3, we would value all of the values in the cells, these 4 cells, and then we would add them to the weighted probability values of all of the interest rates based on the probabilities of the cells before it. So let's go have a look at how that's done. All right, so here we are. We're going to calculate the CVA for a floating rate note, but we're going to do a couple interesting things at the same time. We're going to change the loss severity over the course of the years. So year 1 to year 3, there's an 80% loss. So a 20% recovery rate, 80% loss. Years 4 and 5, we're going to lose 90%. So we're going to change it in the course of the bond. And the probability of default is going to change too. In year 1 to year 3, the probability of default will be 0.5%, but in year 4 to 5, we'll raise it to 0.75%. This is not going to be difficult to deal with at all. Let's look at how we got our expected exposures. Let's look at this last value here, 105.4864. Remember, we had these final values that we arrived at depending on the path we took in the tree. This already has the coupon value in there. That is the maturity value that we would get. The par value of the bond plus any interest depending on where we landed in the tree. Well, we just multiplied by the probabilities of actually getting there, and there's our expected exposure. When we go back to the previous one, time period 4, we have values in cells along with their probabilities, but we have possible interest rates, and these interest rates are associated with the probabilities in the cells before we got to the cells here. So we have to do them separately, and there's our 105.6535, 105.6535. So that's not difficult to get our heads around on that one. Let's see how we handle a changing loss severity here. There's our expected exposure multiplied by 0.8, multiplied by 0.8, multiplied by 0.8, multiplied by 0.9, multiplied by 0.9. That's how simple that is. If it changes over the course of time, there it changed from 80% to 90%, that's all we have to do. Nice and simple. Well, how do we get our probability of default if it's changing? And what I'm going to do is I'm just going to erase the stuff at the bottom of the screen because we've seen it, because I want, well, let's give me more room here. Let's erase all of that because we've seen it. Think about it again like this. It's a tree, right? There's default, 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 and default. So there's no default, there's no default, no default, and then we have default, right? Well, if it's 0.5 for the first 3 years, and then it goes to 0.75 to get the value, the 0.7388, it would be 0.995 multiplied by 0.995 multiplied by 0.995, 1, 2, 3, and then multiplied by 0.75. That's all it is. So this value here clearly is 0.5. This value here is 0.995 multiplied by 0.5. You'll get 4975. This is 995. 995 times 0.5. And this is 995. You could also say it's 0.995 cubed times 0.75. And this value here would be times 0.75 squared. That's it. All right. So what I've done on the bottom of the screen here is I've just drawn out a little more clearly what I did on the previous screen. After I did the last screen, I thought, well, let's just put it down so that you have it in your notes of how we arrived at each of the probabilities of default so that you could see it. It's fairly straightforward, but it's nice just to see it. All right, so we're ready to go. We've calculated the present value of this bond, assuming no discount. We got to 102.3633. we can see that the sum of all of the present values of expected losses total 2.4586. That's our credit valuation adjustment. Subtract that. We have 99.9047 as the fair value of this bond, assuming there's a probability of default. Notice that we have a discount bond. If we have a discount bond, this means that the discount margin, discount meaning what we discount the bond by, is greater than the quoted margin, and the quoted margin we were told was 0.5%. So we have a discount bond. Let's have a look at Exhibit 19. So we left off by saying the discount margin is going to be higher than the quoted margin because we have a discount bond. Well, what is the discount margin? How do we arrive at that? Well, we have to go back to the tree, and we have to use a process of trial and error to see if we can recover the present value of that bond. And we said the present value of the bond was 99.9047. So we have to begin to adjust all the rates in the tree until we can recover this amount. And typically we'd be using Excel. We can use a goal-seek function in Excel. So every cell originally had 50 basis points added. So perhaps we'll add 51 basis points and see what we get. Too high or too low? If we still have a price that's too high, maybe we'll add 52 basis points. If that gives us a value that's too low, well then we'll go to 51.5 basis points. At least that's what goal-seek would do, and it would keep iterating until it recovered this particular value. There is no closed form formula to arrive at that. You really have to do it by trial and error. It's an iterative process. So the nice thing is you won't be asked to actually calculate what the discount margin would be given a mismatch between the price of this bond and, let's say, a par value for that particular bond. But you might be asked to interpret whether or not a discount margin is greater than the quoted margin based on the value that we recover for the fair value of the bond, assuming default. Our next LOS keyword here is interpret. Interpret changes in a credit spread. And I think the book does it very, very well in a particular diagram, which I've replicated on the screen for you. So we have the benchmark yield down here, and we have the spread over the benchmark yield at the top. And it just gives you the components of each. So we can see for the benchmark yield, we have the expected inflation rate, the expected real rate of return, and for risk aversion, some compensation for the uncertainty regarding what the expected inflation rate would be. Macroeconomic factors that affect all debt securities would be captured here. So this affects all debt securities. The spread over the benchmark yield, notice now we're using the word benchmark yield because it doesn't necessarily have to be a government bond. What do we have? Expected loss from default. Well, that could be different, and it will be different for every issue and every issuer. The liquidity of the bond, taxation issues, and we have a risk aversion component. This is compensation for uncertainty regarding the expected loss from default, uncertainty regarding the time and whether or not our assumptions are right. Will we get 40 cents back on the dollar? Will we get 50? Will we get 20? These are microeconomic factors that pertain to the issuer and the specific issue. A few other little points to make here. Securities in which it is more difficult to assess the probability of default and the recovery rate become less liquid, which means the liquidity component in the spread over the benchmark would actually increase, which kind of makes it difficult to pull apart how much of that spread is associated with the credit spread and how much is associated with other things. As the loss given default and the probability of default increase, the credit spread increases. I think that makes perfect sense. If there's a higher probability of default, I want to be paid more. If the loss given default is greater, I want to be paid more. And as the loss given default and the probability of default decreases, the credit spread also decreases. So as a company's fortunes improve and their asset-based bills, the loss given default would be lower. And if their fortunes are improving, the probability of default would be lower. The credit spread would decrease. They are becoming more credit-worthy. Let's look at example 8. All right, here's example 8. It spans about 2 pages, but we don't have to read every word. We just have to hit the highlights. So let's read our setup here. Edward Capilli is a summer intern working on a fixed income trading desk at a major money center bank. His supervisor asks him to value a 3-year, 3% annual payment corporate bond using a binomial interest rate tree model for 20% volatility and the current par curve for benchmark government bonds. I don't know why it ends with government bond par curve again. Just bad grammar there. This is the binomial tree in Exhibit 15. The assumed annual probability of default is 1.5% and the recovery rate is 40%. The supervisor asks Mr. Capilli if the credit spread over the yield on the 3-year benchmark bond, which is 1.5%, that's the 3-year benchmark bond yield, 1.5, is likely to go up more if the default probability doubles to 3% or if the recovery rate halves to 20%. So that's an interesting question. You have a bond with a default probability of 1.5%, recovery rate of 40%. Which would have the greater effect if you went from 1%, 1.5% probability to 3% probability, or if you went from 40% recovery down to 20% recovery? Let's see what we have here. Mr. Capilli's intuition is that doubling the probability of default has the larger impact on the credit spread. Is his intuition correct? So let's scroll down. The first thing we're going to do is we're going to find the fair value of this bond with 1.5% and 40% recovery rate. So here is 104.4152. That's the price of the bond, assuming no default. Then we'll calculate the CVA, which is 2.6984. And if you subtract the two, right at the very bottom here, we have our fair value of 101.7168. So that's assuming 1.5% probability of default, 40% recovery rate. Let's look at the two charts we have down here. This first one, Exhibit 27, we're going to go to 3% default probability. Let's just look at the CVA that we get there, 5.3174. And the second chart over here is leaving default at 1.5, but moving the recovery rate to 20% from 40%. Look at the CVA, 3.5978. So we can see that the CVA, the credit valuation adjustment that we're going to subtract, is the largest when we double the default probability. So let's see what we have. The fair value of the corporate bond falls to 99.0978 when the default probability is raised to 3% and the recovery rate stays at 40%. Let's just flip over to the next paragraph. The fair value of the corporate bond falls to 100.8173 when the recovery rate is reduced by half to 20% and the default probability is maintained at 1.5. So we can see the fair value falls to 99 when we double the default probability. So our conclusion, Mr. Capilli's intuition is correct. Doubling the default probability has a greater impact on the credit spread than having the recovery rate. Well, our next learning objective has us explaining the determinants of the term structure of credit spreads and interpret a term structure of credit spreads. And a term structure of credit spreads is what I have in the bottom corner on the screen down here. This is what we want to get to. To get to it, we'll start with the top graph and see how we extracted the term structure of credit spreads out of that. Up here we have two yield curves. One is for the benchmark bond, whatever that happens to be. Typically it's the government spot curve. And above it we have the yield to maturity structure of risky debt. Now this curve could be for a particular issuer. Perhaps they have different bonds and different debt at different maturities. It could be for a particular rating. Perhaps this represents AA, or it could be for a particular sector. Perhaps this represents retail. The difference between this at each maturity is our term structure of credit spreads. So here we show it as upward sloping. Typically they'll be upward sloping. We're going to see instances where they're downward sloping or where perhaps they're even flat, but typically we would expect an upward sloping term structure of credit spreads, simply because as you have more time to maturity, there is more uncertainty behind potential default. So we would expect to see more uncertainty of default in a 10-year corporate bond than, let's say, a 2-year corporate bond. So let's look at what determines the structure of credit spreads. Number one is credit quality. And this could give us either a flat term structure, an upward sloping, or even a downward sloping. So we'll look at investment grade versus high yield, and then we'll just add in distressed debt. We'll explain why it has a downward sloping curve and explain that it's really, there's no information there. It's just a residual from the way that we would price out the distressed debt. So we'll see that last. So investment grade. Typically, Typically it would be upward sloping, not very steep, but typically upward sloping, so more likely upward sloping for investment grade. If we have stable expectations of default over time, you would have a flat term structure of credit spreads. High yield, this can be kind of messy. Let's look at an upward sloping term structure here. Here we have expectations of worsening future economic environment, simply because we're seeing that we would be compensated with higher and higher probabilities of default as we go out in the maturity spectrum. If we have a downward sloping term structure, we have expectations of better future economic environment. So perhaps right now we're in a recession, but if we continue to survive past that recession, the economy gets better, that probability of default starts to drop. Credit spreads begin to decline. For distressed securities, we would have a downward sloping term structure of credit spreads. For a distressed security, we have 100% probability of default. So it's not really so much a spread. The spread is a residual effect of the security trading for its recovery value. So let's say we know that we're going to get 40 cents on the dollar. Distressed debt will trade for $40 per 100 of par. And you're probably thinking, why would anybody pay $40 for this just to have to sit and wait for a liquidation and get $40 back? Well, imagine if it were selling for $35 and you know that you can get $40 in liquidation. It would be bid up. Simple as that. So the price reflects the fact that if it wasn't that price, there'd be not an arbitrage, but an opportunity for profit in there. So it would be bid up to the point where the difference between the bond's selling price and the estimated recovery rate would represent the uncertainty in the recovery rate. However, I'm getting off topic here, the downward sloping term structure of the credit spread has no information. It's not suggesting that, well, if it's a distressed security that has a longer time to maturity, it'll have a lower credit spread. No, it's just a result of the math. That's all, and we'll see that shortly. All right, beyond credit quality, we have three more determinants of the term structure of credit spreads: financial conditions, market demand and supply dynamics, and company-specific risk. Already sort of touched on financial conditions on the previous screen. Credit risk of a bond is influenced by expectations for economic growth and inflation. So if we have a stronger economy, you will have higher benchmark yields, but you will have lower credit spreads for issuers whose probability of default declines during periods of economic growth. So you end up with a downward sloping term structure of credit spreads. And this is just saying it appears that there is a higher need or a higher credit spread for earlier maturities and a lower credit spread for later maturities, reflecting the fact that by the time we get here, things will be a lot better. Market demand and supply dynamics. One thing we should mention with corporate bonds, they are highly illiquid. Many of them don't even trade in a given year. So you have on-the-run corporate bonds and off-the-run. On-the-run means recently issued bonds. Well, there's a flurry of buying and selling until they're all bought up, and then that's it. Typically, that's it. They don't see the light of day again until they mature. So the volume in credit is extremely low. When there is a transaction, the bid-ask spreads tend to be very, very wide. And if we're basing our curve on the most recent transaction, well, we may not get a curve that's representative of the true credit spread. So market demand and supply dynamics. The credit curve is most heavily influenced by the most frequently traded securities. Infrequently traded, you're going to have wide bid-ask spreads. Frequently traded, you'll have narrow bid-ask spreads. So you can think of a bid-ask spread that's about this wide versus one that is this wide. Well, a transaction is either going to happen here or happen here versus here or here. Which one do you think, if we're observing the last traded price and implying the credit spread from the last traded price, which one is going to have the most influence on our calculation of a credit spread? Clearly the wider the bid-ask spread, right? So infrequently traded, you'll have a wide bid-ask spread versus a narrow one. This will distort the implied credit spread. So if we're just observing prices and from that implying what the credit spread is, for corporates, we have to recognize that, you know what, most of them are basically illiquid all year long. And then finally, you have company-specific risk. All right, let's deal with the downward sloping term structure of credit spreads for distressed securities. And let's make our conclusion up front. This is just a residual. There is no information in this curve at all. If we look at the 5-year, it has a credit spread of 17.1124%. The 10-year, 6.5958%. That means nothing. Somebody looking at this may say, well, perhaps there's a higher probability that the 10-year may actually recover. And that there's a higher probability that the 5-year will default. Well, we're gonna fix that in our assumptions and show that there's no information here. Let's take a 5-year and a 10-year zero, and let's give them both a 100% probability of default. It's going to happen. And the recovery rate is 40%. We're going to assume a flat benchmark curve at 3%. Both bonds will trade for $40 per 100 of par. We're going to assume there's no uncertainty in this recovery rate. It's going to be 40%, so they'll trade at $40 per 100 of par. For the 5-year, if we calculate what the yield to maturity would be for the 5-year, assuming no default, N is 5, payment 0, future value 100, payment is 40, you would get 20.1124. Take off the 3%, the spread is 17.1124. If you do that for the 10-year, you get a spread of 6.5958. But again, there is no information in this. They are both going to default, both 100%, and both will recover 40%. That's it. Throughout the reading, I've been mentioning that the government spot curve is probably better referred to as the benchmark curve to determine what the credit spread is. And so I'll explain why using the term benchmark is better than the government, saying government, the spread over the government rate. The government spot curve could be the benchmark curve. We could be using that. But if we're using the government spot curve, let's say that we have something like this. Here's our 10-year. Let's say here's our 20-year, and here's our 30-year. If we want to know what the yield to maturity is on the 10, the 20, the 30, we just look at the on-the-run government bond, and we'll put a dot on the chart wherever it happens to line up on yield to maturity. And then we just draw a straight line between those 2 points. Well, there's a lot of time in between here. 11, 12, 13, 14, 15. We can observe a 13-year government bond. We just have to find a bond with 13 years left to maturity, which means a 20-year bond that's 7 years old. It'll be an off-the-run bond, but it'll trade at different yields to maturity depending on where along the curve we are. So we're not going to get rates in between the 10 and the 20. So if we have a 15-year corporate bond, what's the credit spread? Well, we would have to interpolate between the 10 and the 20 and determine what the spread is above that curve. That's called the G spread. Using a swap curve would be better. The swap curve is based on interbank rates. It's often used because there's greater swap market liquidity for off-the-run securities, which means all of these securities in between the dates where you'll only get on the run government bonds. So if we're looking for an 8-year corporate bond, well, there is no 8-year on the run government bond. There's a 10-year, a 5-year, there might even be a 7-year. There might, depending on the country you're in, might be a 7-year. But if there's a 5 and a 10, you have to interpolate between the two. The swap curve, it has greater liquidity across all of those maturities. For our last learning objective, we're going to compare the credit analysis required for securitized debt to the credit analysis of corporate debt. When we're looking at corporate debt, we have a company to look at. So there's a lot of things that we can do to assess the credit quality of the debt of that particular company. For securitized debt, we're buying a bond from an SPE, a special purpose entity, whose sole purpose is to hold the pool of assets backing that particular bond. That's its whole balance sheet. So how do we assess the credit quality of that particular bond that we're buying, of that mortgage-backed security or that asset-backed security? Remember now, it's backed by a pool of assets. So imagine a mortgage-backed security, and let's say the total issuance is, let's say, $5 billion, and there are literally thousands of mortgages backing that bond issue. What credit rating does that bond issue have? Well, you can't possibly assess all 5,000 mortgages. So let's look at four dimensions that we can use to look at the credit analysis or credit quality of a mortgage-backed or asset-backed security. We'll look at homogeneity, granularity, origination and servicing, and the structure of the secured debt transaction itself. So homogeneity, this is the degree to which the underlying debt characteristics are similar across individual obligations. So we can have homogeneous debt obligations or heterogeneous debt obligations. So let's assume that we have credit card receivables, $1 billion in credit card receivables. Well, that could literally be thousands of individual creditors in that pool. But let's say that they all have credit scores between, let's say, 750 and 800. Well, we don't have to look at all of the debt obligations. All we have to do is just look at the class and say, well, if they all have credit scores, every creditor in this pool has credit scores between 750 and 800, we can just look at the default probabilities in that particular class, and that's it, and just extrapolate that to the whole. Heterogeneous, well, scrutiny would have to be on a loan-by-loan basis. This is more so for commercial mortgage-backed securities, where the value of each loan in a commercial-backed security would be quite significant. So in a $1 billion CMBS bond issuance, there might only be 20 loans backing, a pool of 20 loans backing that bond issue. Granularity, this is the actual number of obligations in the structured security. If there are many, we would draw conclusions based on summary statistics. If there are fewer, then of course analysis of each individual obligation. Origination and servicing, even though we're holding an asset-backed security, we still have exposure to the operational and counterparty risk over the life of the securitized asset. The operational risk and the counterparty risk, this is the originator. And why do we have that? Well, you need a servicer. A servicer is somebody who's going to collect all of the payments and pass it on to the SPE. Well, there's your counterparty risk. What if they don't pass it on? What if you have a credit card backed bond, credit card receivable backed bond, where for the first 3 years as payments come in, any principal payments can be reinvested in more debt? Well, that raises counterparty risk. And as far as servicing, it's the ability of the servicer to effectively manage and secure the portfolio over the life of the, manage and service the portfolio over the life of the transaction. So, auto loans. There's a default on an auto loan. The servicer has to repossess that vehicle, bring it to auction, and sell it. So you are exposed to the operational efficiency by which the servicer can do that. The structure of the secured debt transaction. Here you're looking at the SPE itself and any structural enhancements such as over-collateralization or credit tranching. When we say looking at the SPE, does the SPE truly own the assets? Have the assets been truly transferred to the SPE? Is there bankruptcy remoteness such that if the originator went away, the assets of the SPE would continue to survive? There's also something called covered bonds, where you'll have the SPE, and there's our SPE. I'll try to draw it out for you. And here is the originator. And let's say that something happens to the SPE and the SPE goes away, and you're holding a bond issued by the SPE. Well, then you can go to the originator and say, hey, you owe me this money. That's called a covered bond, where the originator basically guarantees the bonds of the SPE, even though there is bankruptcy remoteness, so that if the originator goes away, the SPE continues to survive. But if for some reason the SPE fails, the holders of these bonds can then go to the originator.